of the things I always tell my clients is that if we're pursuing rental increases, we have to know what is our actual expense to replace a resident. What's our cost and loss when we replace a resident?
To your point, I don't think many folks have done that math. Like they don't actually understand. They implicitly understand, yeah, we're gonna have to spend some money to turn it over. We're gonna have some lost rent. How many weeks of lost rent? Some, maybe is it three? Is it five? Is it four? It depends on your market oftentimes to answer that. But I think a lot
Mhm.
of investors understand that they want to maximize the retention and minimize turnover, maximize the renewal rate, which is somewhat of a faulty metric in a lot of ways. But they know that they want to maximize those specific data points, but they don't understand the actual ramification if they don't. What's going on, everybody? Welcome back to another great episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Stacey Hampton, who has over 25 years of multifamily property management experience as well as asset management experience. And I am incredibly excited to release this episode because I think this is going to be one of the most valuable and tactical episodes, specifically as it relates to the topic of multifamily operations and asset management that I've released on this podcast. This is one of those episodes where after we were done recording, I was like, I got to make some calls. I got to go and change some things in our business. We get really deep into the weeds in regards to how to maximize the NOI of a multifamily property. Stacey's an expert in this field, and she actually runs a consultancy firm where she works with multifamily operators and investors who want outside help and an outside pair of eyes to help them evaluate their property's financials and current operational status, and to actually help them increase the NOI of their asset as they prep for a sale or refinance, or just in general in regards to understanding how they can maximize the NOI at a property just throughout the normal course of operations. So, all kinds of gold in this episode. How much turnover is costing investors? The one KPI that is critical that investors track. Different tech that she's seeing more sophisticated multifamily operators and property managers leverage to reduce delinquency, and to reduce renter fraud during the application process. We get into how you can maximize your renewal rate by making more unique offers upon lease renewal. I mean, this is just like an extremely tactical episode. So, highly recommend that all the multifamily operators, property managers, investors, whoever, listen to this episode. Even if you're an LP, I bet you learned something by listening to this episode because it'll help you evaluate the quality of a sponsor in regards to how they talk about the management process at a given asset. And you'll probably just find it interesting if you just like real estate. So be sure to stick around and give this whole episode a listen. Really, really excited to post this one. Be sure to connect with Stacey on LinkedIn as well, which I mentioned at the end of the show. She's constantly posting really valuable and tactical content on LinkedIn that actually brings some value to your feed every day if you're someone who's connected with her. But without further ado, let's get to this episode with Stacey Hampton. All right, Stacey, welcome to the show, and thanks for making the time. I'm excited for our conversation here. How you doing today?
I'm doing terrific. Thanks for having me. I love your show, and I'm looking forward to chatting with you.
Yeah, absolutely. So I gave a little bit of a high level bio on you in the intro, but why don't you share a little bit more about how you found real estate? Maybe go back however far you'd like to go in terms of how you got into the business and what you've been working on since you got into real estate and what you're working on today.
Yeah, so I actually started in hospitality and had at one point a portfolio of six different states that I covered. I was the sales director or regional sales director for a large hotel group. And at some point, I got introduced to multifamily, and it just occurred to me, I was like, man, there's probably a lot of correlation between the two. I kind of got interested in it, started talking to people. And then I decided, you know what? I would really like it if I didn't have to replace my residents every day.
Yeah, right.
and and feed them, right? Like food and beverage and events and conferences, and the hospitality industry is 365, and it's a real grind. So I got interested in it, and I got my start with a management group that I had to start at the bottom, so to speak, right? Entry level, and it just took off from there. Fell in love like everyone does.
Love it. Yeah, and now I know you have a very interesting service, to quickly touch on the business that you're currently working on, how you're helping owners right now maximize NOI, better asset manage, and operate their properties. And in my opinion, just from afar, I think it's a really unique model, and I don't think there's many folks who are doing what you're currently doing right now. So why don't you share a little bit more about who you serve today, kind of who you work with, who you help, and how you work with multifamily investors?
Yeah. So about a year and a half ago, I started a multifamily asset management operational consulting firm. So I've worked for 25 years in multifamily, so that hospitality stint was a very long time ago. But in 25 years, I've worked in asset management and operational management, most recently president of a vertically integrated management company. And so what I do now is, it's easier said. There's a lot that goes into it, working both as a between asset management and property management, but I build better business plans and I work with the operations team to execute them and all the service partners and suppliers for assets and portfolios. So think of it as kind of a potency punch, right? Like it's usually very short term. I jump in, I look at a specific property or portfolio and identify how can we increase revenue and NOI at this property. Pick the top two or three things to focus on and build the plan from an asset management standpoint and the business strategy. And then I work directly with the team on the execution side.
Love it. No, I mean it's an interesting time to be having this conversation, given who I'm sure a lot of the folks that you work with are. I think it's topical in that there are many folks who need some help on the operational side at this particular juncture in the if we want to use the word cycle, I guess we can use cycle, but a lot of folks over the last 5 years buying deals on cheap capital who
Yeah.
who didn't have backgrounds on the operational side when they got into multifamily. It was, I can raise capital, we can put together the dollars, we can go buy a deal. We'll figure out the asset management or the operations afterwards. We'll hire our third party PM and they'll do a good job and we'll see them at the finish line when we sell it. And I think a lot of folks right now are realizing over the last 12, 24 months that they need to become much more involved on the operational side. And that's not just, a byproduct of buying a deal. It's a really important part of the investing process. So I'm excited for our conversation right now in the sense that I think this is really topical for a lot of the folks who are listening that maybe are realizing like I really do need to spend a little bit more time dialing in the asset management process around how we actually operate our portfolio. Because I think a lot of people that's just been on the back burner as they've grown over the last few years. But let's start high level. I kind of want to start high level and then we'll narrow down in terms of what we talk about. Real high level, simple question, because I think oftentimes investors, especially newer investors, blur this line between property management and asset management. And those are two very distinct roles in the operational and investing process that it's some people that they don't really have them clearly defined in their mind. They think their property manager should be doing work that is really their responsibility as an asset manager or whoever the asset manager for that deal is. And some property managers are really great and can help with that. And they cross over to the other side. But in your opinion, how would you define like the line between property management and active management? And I know this is a nuanced question, but would love your thoughts on how you delineate the two.
Sure. So, I mean, from an asset management standpoint, you have the full view of the business plan from the underwriting and on, right? So I think it's more of a at a strategic level. You know what the property needs to achieve in order to get the results and the proceeds when you exit or refi, right? So I think from that standpoint, understanding how the property operated under the previous owner and working with the management team to build a strategy that will get you there. So, just as an example, we're picking up a property, let's say, at $24 million and it's a five cap and we're planning on an exit of 28 million in 3 years. It's up to you to explain to the property management company what it is you're trying to achieve and being specific in that. And that's one of the things that I think a lot of people, asset managers, miss is that they need to know specifically, what are the numbers that you need to hit? And I think a lot of times asset management tries to get in the weeds about we need to be at this rent level, we need to be at this. And I think a better conversation is, hey, we're trying to increase NOI $214,000 or whatever this year. Tell me how we can get there. You know what I mean? Based on this,
Hmm.
whether it's rents, whether it's savings, whether it's additional line items, let the management company help you develop the strategy to get there. But you've got to tell them where you need to go, where you want to go. And I think sometimes it's just too generic when you say we need to increase rents by 150. Well, the market may not support that, but that still doesn't mean you can't increase income
Yeah.
to get to that same end.
Yeah,
So
exactly. And I want to dive into that too, because there's a couple ways that we can take this where I know a lot of the folks that you work with, a lot of the investors that you work with, you help them prepare a building to execute that capital event, whether it's a refi or a sale, and they're bringing you in to help. And I might be taking words out of your mouth here, but whether it's we'll fundamentally maximize the NOI so we can achieve the highest and best value. But behind that, there's all types of different things that we can do to drive that NOI as we lead up to a capital event. And then I'm sure a lot of those strategies are also just generally best practice strategies for operating a multifamily, regardless if you're about to execute a capital event. But I think that's oftentimes when many investors really lock in from an asset management standpoint is the 6 months, 90 days before that key event. When somebody brings you in, when a client brings you in, what are some of the things, and let's say that's their objective, right? They have this asset, they're planning to sell, they're planning to refi, they want to get your opinion on where can we maximize NOI or increase NOI. What is like a very high level step one? Where do your eyes go? Where do you begin your thoughts in terms of actually trying to determine where you might be able to create some NOI when you're looking at the P&L for a client's property that they might be bringing you?
sure, let's just say 6 months out, right? You're planning a capital event in 6 months, whatever it might be. I'm looking at the T12 and the first thing obviously is to go to the rental income, total rental income. And traditionally and historically, we would look at, okay, how can we increase rents? And what occupancy do we need to be at? And occupancy meant leasing activity to a large degree. So the way I look at it now, and it has changed slightly, is I'm looking at first and foremost write-offs. Write-offs are absolutely significantly higher than they were even 2 or 3 years ago. And what
And
I'm
I'm
seeing
sorry for
there is
interrupting, but to clarify, write-offs, are you speaking concessions or
no,
incentives
no.
different?
When a resident moves out and owes a balance.
Gotcha. Delinquencies, write-offs. Gotcha.
Right,
Perfect.
right. So it's an unpaid balance. I'm looking to see how much of the rental income is not being collected.
Hmm.
And additionally, I'm looking at the vacancy. And those two are very much in line with each other. If your write-offs are higher, your vacancy's higher, unfortunately, right? So that's the first thing that I will typically tackle in looking at, or what I normally see when I look at a T12 as the greatest opportunity. How can we reduce the write-offs and reduce the turnover? Obviously, if they're at a below 90% occupancy, I'm looking at how to increase occupancy as well. But I'm not a best practice practitioner. What I do is extremely specific to the asset. So I do a forensic analysis on every single property that I look at. And I know what their monthly traffic is. I know how many write-offs they have. I know what the average day vacant is between residents. And so I'm doing that deep analysis to figure out what are the habitual performance patterns for this property, and how can we um, basically impact or retrain the property to produce more revenue. So whether it's vacancy, turnover, write-offs, I'm also looking at utilities and utility bill backs. That's usually the fastest, quickest way to increase NOI if the property's not getting, 85, 90%
Hmm.
bill back rate.
Yeah, and I think one of the important concepts I should say that investors need to grasp is that increase in revenue and collected revenue, whether it's decreasing physical vacancy and or decreasing write-offs or delinquency, increasing rents, most of those dollars just drop straight to your NOI, right? Because it's your taxes are fixed, your insurance is fixed. By and large, your common utilities that the owner pays for is relatively fixed. I mean, granted, if you're paying water, sewer for a building that's 100% occupied versus 80%, those two bills are going to be different. There's more people, but more or less, the majority of the expense side of your PLN is fixed. Your contract services are fixed. You're going to pay the same amount to mow the lawn and to do plowing in the Northeast or the Northwest or the Midwest in the winter. So
Right.
taking your eyes to the revenue side, I think, is really important. And I think it's interesting that you go straight to delinquencies and write-offs because I think that's oftentimes an over or under discussed and overlooked component of the P&L. I think everyone wants to go right to the rent roll. Where can we push rents, right? That's, I think, everyone's kind of first thought. But if you're not collecting the rents that you're charging, I mean, it doesn't even matter. Is there something tactically that you implement or try to work with an investor to achieve in regards to helping them actually go out there and reduce those delinquencies? Is there something that you try to implement or help them implement on the PM side or coach them to help their PM implement that actually starts to bring that down?
Yes, most definitely. I'm glad you positioned it that way because you're right. Most people try to go to rents, second occupancy, but at the end of the day, what we're trying to achieve is increasing NOI. And specifically, just talking about write-offs, write-offs are sometimes residents who move out who owe several months' rent. And sometimes it's just write-offs where maybe they didn't pay the last month's rent or they didn't pay their last utility bill. So when we're talking about, and I know your listeners are probably, some of them have, under 100 units and some of them probably have over. So the impact is greater depending on the situation. But when a resident moves out, they very frequently leave an unpaid utility bill, right? That's not an uncommon occurrence. As a matter of fact, the average resident that moves out that doesn't owe rent often owes in damages and unpaid utilities on average $415 a unit. So that's $415 that's just gone. But in many cases, they owe more than just their unpaid utilities and cleaning fees and damages. They'll often owe several months' rent. And in those cases, what we're seeing a lot of in the industry right now is a lot of fraud and unqualified applicants that are living in these communities, and they're having a substantial impact. One of the examples I was talking about with someone today is, used to when we would underwrite write-offs, we'd underwrite them somewhere around 1 to 1.5% of net rental income, for the year, right? So now what I'm seeing in actuality is somewhere between 10 and 15% of net rental income.
Wow.
So it's not uncommon to see, like on a 200 unit property, to see write-offs north of $100,000. And that is largely due to, a lot of the qualifications and screening applications that are being used aren't properly preventing fraud, but they're also not screening out the people that really shouldn't be qualified.
Mm-hmm.
And so these people move in and they're there for a few months. And I know probably a lot of your listeners have experienced this. And then all of a sudden they quit paying their rent. And that's compounded by the different jurisdictions and how they handle evictions. Sometimes it only takes 60 days. Used to only take 30 days to evict a resident, and a resident that doesn't pay. Now it takes, in some markets, 6 months up to a year.
Yeah, you said 30 days, and I live in Massachusetts, and some of the Mass folks listening to that are like, yeah, it's in your dreams. And they're closer to that 12-month time frame, right? So it's like, on the screening side, it's critical, especially with AI, and you can just whip up a fake pay stub pretty quick if you're a tech savvy resident who's down to commit some fraud, you could do so fairly easily, right? And I think the screening process really needs to be much more dialed in for a lot of the more legacy PMs that have kind of just, send us some pay stubs. We'll call your previous landlord. We'll do maybe an eviction check or something like that, and some, more stuff is slipping through the cracks. So I think that's really important on the front side too, as it relates to the placement side. One last question on delinquency, because I do think it's a really good topic, is there anything that you try to help, or it might be outside of the scope of the, what you're working on with a particular client, but any tips, anything you see that really good operators, good asset managers are doing in regards to actually trying to get in there and collect after a tenant moves out, or to mitigate that 415 average balance you mentioned, or sometimes higher when there's a few months in unpaid rent when somebody moves out. You see any best practices or approaches that good asset managers take to actually try to shave some of that down post move out with a tenant or a resident?
Absolutely. Well, there's several options, thankfully. Because this is such a widespread problem in the industry right now, we've had a whole lot of new solutions that have come to market in the last 24 months. So besides looking at your applicant screening and making sure that you've got identity verification, employment verification, and an AI document screener, I would then, look at either one of two things. Part of what used to offset some of those losses were deposits. And keep in mind, this varies by market, right? In the Sun Belt market, we've got high concessions and we've got waiving of deposits, application fees, because we've got a lot of supply in the market right now, versus in the Midwest or Northeast, they may not have the same challenges, but deposits offset that. So if you have a deposit, that if you know what your average unpaid balance is at your community, which that should be very easy information to get, you want to make sure that your deposit is at least that much, right? Because then you're making sure to capture that. The second thing is if you're, say, in a Sunbelt market, where if you had a deposit equal to 1 month's rent, that might be challenging for your residents, then you might look at a deposit replacement type program where residents, particularly ones that are on the line of being approved, sometimes called approved with conditions, can use these deposit replacements that will offset or pay those final balances. And then the last thing is, I anticipate that this is only going to become more challenging for us, is because economically our residents are being challenged right now by inflation. And so therefore they have less discretionary income, which ultimately causes them to be less financially stable. And so flexibility is something that could benefit some residents. And here's what I mean by that. In the past, you've had basically two mindsets. You've had collect all the money up front, or file eviction so that we can get the process started, or do we work with them and take payments, right? And hope that we can take payments and they'll get caught up at some point. And I'm not going to argue which is best, but what I am going to say is that there are now options for these residents where they can go through one of the organizations. I normally don't name companies, but Flex is an excellent organization that helps your residents for very low, very, very low fee, pay their rent, and you get your rent directly on the first. And then it's something like $7 or $10 for the resident to break their rent into two payments. And so that really, it helps the property sustain cash flow, and it helps the resident with the flexibility without you giving up. Because what happens is when you work with a resident so much, they begin to rely on you working with them. They're like, oh, I'll pay Axel. He knows I'll pay him mid-month, but eventually it gets out of hand for them, right? They get used to paying late, and then one day, they never get caught up again, and you have to evict them or they skip.
Yeah. And it's tough because it's obviously the part of this business that nobody likes at all. It's the worst part of this business, by far, is getting into a situation and trying to arrive at some type of amenable solution for both parties, a resident and an owner or a management company, and trying to figure out how do we solve the problem of being a couple months behind and get you caught up so that we don't have to worry about, sending balances to collections with downstream impacts, credit scores, downstream impacts your ability to get the next apartment that you want to move into and all of that. And, on your note, I think there is a lot of technology that's being introduced in the space. I haven't heard of Flex. I think that's a platform I'll probably go and check out. But there's a lot of like deposit alternatives, right? Like Rhino is a big one. In the building that I live in, Rhino is a service that replaces the need for a security deposit with some type of deposit insurance. And not the only company that's doing that. And I think that there's a lot of different prop tech companies, software companies that are actually looking to solve these various different issues, whether it's ongoing payments or upfront deposits to get somebody into a unit. And I think if you're an investor who's not leveraging any of those different types of software, and you're somebody who's actively managing your portfolio, it's probably time to take a look at it, or ask your third-party PM if they use any of these platforms, because you'd rather be ahead of this curve here on this topic. Whether it's related to this discussion of maximizing collections, decreasing delinquencies, deposit alternatives, et cetera, or otherwise, whether it's services that you see operators providing tenants that maybe give them an opportunity to slightly upcharge above their cost of providing it, but also as a value add to the resident, or any other types of services or tech that you're seeing operators implement to maximize NOI. Any big ones that come to mind right now, whether it's a specific company or platform, or whether it's different components of the asset management process that you see tech really starting to help a little bit more so now than maybe the last couple of years?
Sure. So I think one of the things that I like, and I want to preface this with say, I'm not a big fan of taking on large liabilities for the monthly liabilities for the property. Particularly because you don't always get paid for them. So I won't mention any names, but when you take on a monthly expense with a plan to upcharge, sometimes depending on the asset type and the demographic, like I said, if there's $200,000 a year in write-offs, chances are they're not going to be paying you for those big ticket amenity items.
Like cable is an example of one, right? Just for listeners' sake. Yep.
Yeah, exactly. So my favorite is parking. It's one of the things we already have, and you've probably heard a lot of people bring up reserve parking, covered parking, garage parking, all the different, but there's a lot of technology out there right now to help you manage and maximize your reserve parking in any sort of way. And it's something that the residents really want. When you are driving in, for those of us who live in a home, we know where we're going to park every day. We pull into the house, we know where we're parking, we know how far we're going to have to carry our groceries or whatever we have, right? Versus a resident without reserve parking, and they're pulling in and they don't know how close they're going to get to their apartment. They don't know, and there's an anxiety level, and you don't have to come home at 9 or 10 o'clock at night and have to park 3 buildings over too many times before you realize the value in it. So there's a lot of different apps out there. It's something that doesn't have a huge liability or capital cost associated with it. And it's something that the residents consider very high value. So my methodology in this is I always price the parking that's closest to the door, the highest, and work my way out, right? Whether it's a garden style where we have, 10, 15 buildings, or we've got a garage and we're talking about getting next to the elevator, price them out. But the main thing is that, understanding that your highest value parking spots are always going to be the ones closest to the entrance or exit to a building or door.
Yep.
And residents are happy to pay for that convenience, knowing when they get home that they have.
I mean, you're basically buying back time, right? If you're a resident, right, you're buying back seconds and minutes of your day, which is a really easy sell as a PM, or for the PM company, and then the asset manager who's managing the PM. In terms of big KPIs, so we talked a lot about, we want to maximize revenue, and there's the different levers that we pull in order to do that, which then trickles down into maximizing NOI. I'm going to list the big KPIs that we've already talked about, right? Like vacancy rate. That's where your eyes kind of go on both physical and economic vacancy. How many bodies are living in the building, versus how many of those are paying as well. Obviously important to delineate between the two. Looking at the write-offs and the delinquency, et cetera, that being a KPI. Other KPIs that you think are really, really important for operators to track, maybe some of the big ones that come to mind in terms of just ongoing asset management. Maybe we're not leading up to a capital event, but we're just, we close the building and we just want to do a great job operating at post-close. What are some of the big KPIs that investors should be diligently tracking and referencing on a regular basis?
Well, if we only talked about one, it would make all the difference. Turnover rate.
Yeah.
There's literally nothing more important. It doesn't matter to me what market you're in, where you're at. And it's often confused with retention, right? It's your renewal rates frequently. So I want to clarify what I mean by turnover rate. Turnover rate is the amount of people that move out, period. Not renew, not give their notice, move out, because particularly right now there's a lot more residents that are skipping or not fulfilling their lease defaults. And even if they renew, the way that property management traditionally tracks renewal rate is they look at a single month and they say there's 10 expirations this month and 7 people renewed. We've got a 70% renewal rate. What's not calculated in that is any skips or evictions for that month. So I can say that I have a 70% renewal rate, but if I also had 7 evictions or skips for that month, and that's why a lot of times you see like, wow, we're leasing, people are moving in, but we're not gaining occupancy. This doesn't make any sense. It's because the skips and evictions, the lease defaults are basically counteracting. So the turnover rate, take the entire year, average occupied units, and the total number of move outs to calculate their turnover rate. And the reason why I see that, because I say that is because I often see where renewal rates are being touted to be 60, 65%, but the turnover rate is 60% because people month to months, that's another thing that's not usually calculated in renewal rates is month to months. If you've got 10, 15 residents and a 100-unit building on month to month and all of them end up moving out this year and you've had several skips. So turnover is the most important thing. And I think one of the things I'd like to mention additionally to that is, my goal is to reduce turnover in every form and fashion, whether it's skips or evictions or it's residents choosing not to renew. One of the things I posted about this morning was the impact of reducing your turnover rate. If you've got, and I calculate the average total turn cost to be around $5,100 for a B-class property, right? That's rent, that's vacancy loss, that's cost of acquisitions, which is concessions marketing, that's $415 balance owed at move out, that's vacant utilities, and obviously turn expenses. So around $5,100. If you've got a resident who moves out and you're spending $5,100 to turn the unit, market it, and then you've got, the expenses as well, you're going to need a rental increase north of $400 just to break even on the NOI that year. A monthly rental increase of $400.
It's massive.
It sounds like it's only $5,100, but so one of the things I always tell my clients is that, if we're pursuing rental increases, we have to know what is our actual expense to replace a resident. What's our cost and loss when we replace a resident? If we're getting $100 rental increase, it's not going to replace the NOI loss that we have when we're turning a unit, and the vacancy loss and the concessions and everything else. So Reducing turnover with that in mind and knowing exactly what every time you turn a unit, what it costs you, I think really puts it in perspective as far as your strategies that you're wanting or willing to deploy to reduce turnover.
Yeah, I mean that's huge, and I'm really glad that you shared the specific number of 5,100 because to your point, I don't think many folks have done that math. Like they don't actually understand. They implicitly understand. Yeah, we're gonna have to spend some money to turn it over. We're gonna have some lost rent. How many weeks of lost rent? Some, maybe is it three? Is it five? Is it four? It depends on your market oftentimes to answer that. But I think a lot
Hmm.
of investors understand that they want to maximize the retention and minimize turnover, maximize the renewal rate, which as you mentioned is somewhat of a faulty metric in a lot of ways, but they know that they want to maximize that those specific data points, but they don't understand the actual ramification if they don't. And I think this is probably one of the components of an operational strategy that I think many investors have had to undergo like the biggest change in how they approach this over the last few years because I got into the business in 2016 and it was a lesson I kind of really had to start really learning in the last couple of years because 2016 to 2022, yeah, you wanted to maximize your retention, but if a unit turned over, rents were growing at such a pace, especially in the Northeast in our market where it's 10% year over year rent growth, and we're taking a unit from 2 grand to 2,200 just organically with a minimal turn, and cap rates are compressing at the same time. And it was actually much more accretive and value add to keep increasing that rent roll even at the expense of your shorter term NOI. And that is just not the case anymore, where rents are not growing like that anymore. And you're not going to see that commensurate bump in the valley because cap rates are kind of staying stagnant here. And sure, maybe you get another $100 a month, but if you're spending 5,100 and by spending you're foregoing that revenue and you're actually spending it on turn costs, it's a trade that doesn't necessarily make a lot of sense. And all it does is also just stress the day-to-day management of the property as well. In that even if you have an on-site manager who can handle leasing, the more leasing they have to do, the less they're focused on providing a great, service to the existing residents, right? And their focus is being shifted oftentimes as well. So I really want to highlight that
Agreed.
because I think that's a big point. Now, in terms of coaching operators on let's decrease your turnover rate, let's increase your renewal rate. What are some of the things behind the scenes that a PM or an asset manager can coach their PM to do to actually keep people in those units and to mitigate turnover as best they can?
First of all, I think you need to know what your turnover rate is, the actual 12-month turnover rate. And then I think you need to set goals to to reduce it. So if you've got a 50% turnover rate, I think you need to shoot for 45 to start. Like we don't want turnover over 45%. But then of course that's general. So you need to drill down maybe another layer or two and build a strategy of what you are willing to do to get those numbers, right? Like what you're doing already is what got you to 50% turnover.
Yeah.
Right. So you're
Yeah.
gonna have to do something else likely, right? It's not gonna happen by accident. So whether that's negotiate renewal increases, definitely for smaller landlords, I would definitely say somebody who has, 50 units or under, this is super critical. Look at what your average turn cost was on your last 5 units. Look at what was the average time that your units were vacant. How long did it take between the move out and the next move in, and what was the rental loss? And what was your cost to acquisition? Did you have to pay a locator? Those type of things, and really consider negotiating that. Like I said, it's $5,100 is total lost and cost for a unit turn, then, if you're asking for a $200 increase on rent, maybe consider working with that resident, because ultimately it's going to be worth it to do 100 or 125. Also, keep in mind that every time you turn over a unit, you take on it's way riskier than it used to be, Axel. It used
Yeah.
to, again, with the fraud and the qualification, you may get someone in there at $200 or $300 more a month. But what if they only pay you 2 or 3 months? And then they quit paying and it takes a year. So to get them evicted, starting out with just being willing to negotiate, making it a priority and say, listen, if we're getting pushback, let me know because we want to negotiate with these residents and keep them here. I think thirdly is making sure that you're having conversations with everyone that puts in notice. So the managers, every time a notice comes in, before the sun sets that day, pick up the phone and say, I want you to stay. What do we need to do here? I
Hmm.
want you to continue to be a part of this community. And keep in mind that no matter what you do, residents are going to move out. They have life changes, they get married, they get new jobs. There's some things that apartment living is transitional living, right? Very few people live in a same apartment their whole life, but you want to make sure that if they're moving to be 10 miles closer to work, is that something that you can offset for them by perhaps giving them a small concession? I will say one of my strategies that in the Sun Belt, I really like to use is to offer to offset and offer a concession, an increase with a concession. And what I mean by that is I'm going to give you a $50 increase, but I'm going to give you a concession equal to $25 a month. And the reason for that is because hopefully the market will be stronger the next time your renewal is up. And instead of starting at $25 less, I'm starting at 50. I don't know if that makes sense, but
100%.
ultimately that's a better strategy in the long run is, to shoot for a larger increase and offset it with a concession up front in those markets where maybe rental increases are hard to come by right now.
No, all great tips, and the offering the renewal increase with a concession is something that we've started implementing recently, and I think it's really helpful because there's the short-term relief of, hey, I got this dollar amount off my next month's rent payment, which feels like it's money in my pocket today conceptually, and it also feels, I think, especially for residents in smaller buildings that are operated by more, I use the word mom and pop here loosely, but mom and pop management companies or landlords, which is very common in the Northeast, where you just have these thousands and thousands of units spread throughout, Boston, Southern New Hampshire, Rhode Island, et cetera, of these small buildings that are oftentimes owned by smaller owners that are just very straightforward in how they do things. It's here's the increase, and okay, you moved out, and that's that. And there's a lot of rigidity around the actual operational process where if so this is a comment really for the folks out there who are managing these smaller buildings or scattered site portfolios of smaller buildings that have been where the folks who manage those in your market are typically much more black and white in terms of how they approach the asset management side of the business, and specifically during this conversation the renewal part. If you offer these little things, it's oftentimes going to be met with a lot of goodwill because it's outside of what a lot of these folks are used to over the last 3, 5, 10 years of renting apartments or however long they've been a renter. And the other piece of this too is, I think a lot of folks, again, and I think it's just a lot of people were trained in that 2017, 18, however, whatever time frame we want to start with, to this tail end of this really hot market where I'm not negotiating with a resident on the renewal. Like, I don't want to bend because then the next person's going to want to negotiate with me, and then this person's going to want to negotiate with me. And if they don't want to negotiate, that's fine. I got somebody else who's going to come in and pay more. And there was a lot of hesitation to negotiate, a lot of, I guess, pushback there, I think, for a lot of folks, whether it was philosophically or just the idea that it doesn't matter, I can still find another tenant who's going to pay a little bit more than the renewal rate I offered anyways. But I think now, I think a lot of people need to put that aside and actually retain having those conversations because, as you mentioned, there's a lot of risk in finding the next person. And I think a lot of folks are doing some price discovery right now where it's like this next tenant might be coming in at the same rent, not even like an increase, right? It's like
Right.
I think a lot of operators are like, when we offer a renewal, it has to be more. Like, I think there's always there's a lot of folks with that mindset instead of renewing at current or even a slight discount to prevent turnover. Like, I think that is a big conceptual change for a lot of folks because they've never had to do it before, So I think it's oftentimes it's the mental hurdles around that stuff. I feel like too, outside of just the dollars and the cents.
I agree, and I want to add something to that. If you're wondering whether or not you should negotiate, my response is do the math and find out. Find out if it's $5,100 or is it $7,000. That's why it's so critical you have that perspective. That's what I do for my clients. I dig in and I get those exact numbers And I come back to them and say, listen, no question, best case scenario, we're going to lose at the minimum half of this number because this was your average loss and cost on the last 10 units that you turned. At best case scenario, we'll lose half. So it puts it into perspective what you should negotiate, what your resident is truly retaining that resident is truly worth to you
Yeah.
as an owner. And ultimately the successful execution of a strategy with that in mind will absolutely increase your NOI substantially. I forecasted a 10% based on a strategy that was implemented for one of my clients' portfolios. And just at one particular property, it was a 10% reduction in turnover that was going to render $134,000 in NOI because of just that 10%, which 10% sounds like a lot, but it really wasn't. It's, a 300 unit property. So about 2 million for this property, somewhere around $2 million in value. So if you were chasing $100 increase on rent, but you still, again, you're not offsetting that $5,100 loss or what it was for this property, your proceeds are going to be less. There's just no ifs, ands, or buts. If you were to take that property to the market, your proceeds would be less just by chasing that $100 versus the 10% reduction in turnover
Yeah.
by
It's
about 10
funny,
hours.
100%. In our business and because we own our management company, we have one of our remote team members who's just works remotely for us out of the country, and one of their sole jobs is trying to convert folks that issue, notice to vacate, they're not renewing their lease, calling them and trying to figure out why that is. And, there's a little bonus involved if they convert somebody who previously should notice to not, to really incentivize. And oftentimes, again, as you mentioned, you can't win them all, right? Because sometimes people are like, I'm moving out of the state, whatever it is, took a new job at this different town. But a lot of times it's like there's some very simplistic reason where it's like, oh, this maintenance request hasn't been dealt with for a long time and I'm like a little PO'd about it. Or, this upstairs tenant is a problem and I just want to get away from this individual or this person. Or I think, again, this is an old buildings problem here in New England, the early 1900s stuff. I think there's some weird cross wiring. My electric bill is really high. And a lot of solvable problems behind the scenes as it relates to, oh, well, we can address that, or I can even just address that right now with you on the phone. Hey, that person upstairs is moving out in 2 months. I don't know if you know that, and your lease is up in 3, so maybe you hold off on actually issuing notice until they move out. And there's a percentage of those notices can be solved with some type of one-to-one conversation, which again, I think many people just assume that that's not the case. They just get it and they say, okay, they're moving out and that's too bad. And now I'm going to have to go and solve for the next thing. Last thing being, oh, the rent's too high. Well, let's talk about, and that's the most common one, as you mentioned, right? Well, let's talk
Sure.
about how we keep you in there, right? And you get into a little bit of a one-to-one negotiation, but you have to be willing to have that conversation. And I think it's as much as the dollars and the cents are so impactful, for some reason, I think that there are still many asset managers that don't like the idea of having those one-to-one negotiations, which I don't get. And it's you're stepping over dollars to save pennies. But I think partly it's the market trained everyone to not think that way for a very long time. Anyways, that's an aside, but
No, I would definitely agree. And by the way, I want to make note that you are the only person I have ever talked to, and hopefully someone will listen to this episode and say, I do this too, but you're the only person I've ever talked to that actually has somebody in their organization with that specific role. But I can only imagine the ROI on that has got to be yeah, to the
yeah,
moon, right? It's like something I've heard once that the IRS, for every dollar we spend on the IRS, we get a $250 return or something like that. It's like the best investment the US government makes.
yeah,
I can't even imagine, what kind of return you're getting on that effort. But it's substantial. And to my knowledge, no one's doing it. So
yeah.
yeah,
And it
I
can be
think
somebody
people
virtually too. It's one of those, it's a perfect textbook role for somebody virtually, right? It doesn't have to be a US based person.
Yeah, a million percent. And I think that, for somebody who most companies, most organizations, most owners think about turnover, notice to vacates as something that's fixed. It's done, it's done. You really can't save people. Or they think same thing with, write-offs or delinquency. I don't think they really believe you can materially improve that, but I'm here to say that you absolutely can. And there are a few things you're going to be doing that's going to have a higher ROI than reducing your turnover. Very
Yep.
few. I honestly, I can't think of anything at
Yeah.
the top of my head. Not in this
Yeah.
market, I know. So,
It makes it a really easy conversation when it's a very singular answer. It's just, hey, get better at this one very specific component of it, and the returns are just significantly outsized comparatively to where else you can spend your time. And it makes it an easy
yeah.
conversation for sure. All right, Stacey, this has been great. I really appreciate your time, and I'm sure all the folks listening here are probably going to start making some changes behind the scenes in terms of how they approach the operations of their assets. Where can folks get in touch with them? Where can they learn more about you?
Well, I'm super active on LinkedIn. I give away all my secrets, which really aren't secrets. Everyone knows them, but I give away all my strategies on LinkedIn, so you can find me there. I post just about every day, or you can find me, if you want to see what I do and kind of get a better feel for the services I provide, you can look at my website, assetnoi.com. Um, and reach out to me there as well.
Love it. I will also plug your LinkedIn because it's a great source of information for me as well. So I highly recommend everybody out here go and follow Stacey or connect with her on LinkedIn because it's nice tactical advice that you can use in your business on a regular basis. But thanks again for taking the time, and it was great recording this. And I'm going to be probably calling our team after we're done here and saying, hey, let's go and refine our math on the turnover side and post it on the wall in our office. It's funny, we as an aside, we have a wall in our property management office that's like for every day of vacancy, we cost ourselves or our owner client X amount of dollars in lost revenue. But I want to change it to every turnover costs our owner this dollar amount, right? So getting away from just the vacancy, but the total cost. So that's a good one. I got to go and do that math now.
Well, that's how I feel after I listen to your podcast. I'm like, all right, I need to write notes down, figure out what I'm going to do with this information. You give a lot of great data. I have a particular favorite episode we'll discuss another time, but I really appreciate you having me on. I feel super honored to be here talking to you and on the show and to your listeners. Thank you.
Love it, Stacey. Thanks again.